Hi everyone, Chris Irvin here, Director of Equities Education at Market Traders Institute, and this is your Spy the Market for the week of October 30th through November 5th. Glad to have you along today. If this is your first time with us, you need to understand that this is a high-level overview of the markets. We take a look at some of the stories that impacted your trading last week. We look forward to some of the stories that may be impacting your trading this upcoming week, and then we jump into the charts. So let's go ahead and begin. This first story I found on Yahoo Finance, and it says corporate America's earnings recession may have finally ended. So we had several quarters of negative earnings as the markets were not doing great, but as we're about halfway through the earnings season, the heaviest part of the earnings season was actually last week. We'll have quite a few more announcements this week, but overall, earnings aren't looking terrible as were expected. So that should be kind of an uplift to the markets. But I think there's enough things going on in the markets that could cause some more uncertainty. And as we know, the markets hate uncertainty, that we could have a little bit of a rough ride coming up. This next story from Investors Business Daily says stock indexes gain little despite 2.9 GDP pop. So the big story last week actually came on Friday. There were multiple big stories on Friday, but the one that we anticipated was actually the GDP report. And the GDP actually rose significantly to 2.9%, and it had been stuttering along right around 1%. So this was actually a good thing for the overall economy. And that news should have lifted the markets pretty dramatically over the day, but the big story had to do with political jitters. This story on MarketWatch says stock market braces for political jitters as Fed likely to stand pat. Now, this takes us back to the big stories. You know, from the beginning of the year, the big stories have been oil prices, the Fed raising interest rates, and off the top of my head, that's about all. Okay? So we've got stock market braces for political jitters as Fed likely to stand pat. Now, everybody's anticipating that the Fed is going to raise interest rates, but not this month, next month, which brings us to our first roadblock this week, or I should say speed bump this week. This week, we're going to have the Fed announcement on Wednesday at 2 o'clock, and that there are two main economic announcements that come out in the United States that are considered to be the Super Bowls of all economic announcements, okay? They're the big ones. The first one is the Fed announcement as to whether or not they're going to raise interest rates, and the second one is the jobs report, non-farm payrolls. Now, just so happens that this month, both of those things are going to happen within the same week. So we're going to have the Fed announcement on Wednesday, and we're going to have the non-farm payrolls on Friday. Now, that's pretty unusual, and when we add those things together, we're going to end up with a very volatile week, and then we're going to have one more, some more gasoline poured on the fire, if you will, and that's going to be what is the fallout from last week's shocking announcements. I guess I shouldn't say shocking, but huge announcement that the FBI has decided to reopen the case on Hillary Clinton. And as you know, that when that announcement was made on Friday, the markets absolutely fell straight down. If you were watching the charts, it was an amazing move. So recovered a lot of that move, but I think the markets are still uncertain about which way they're going to go. So this next story says the dollar surges, and the dollar surges goes from roadblock to all clear signal for the Fed. Now, what this story is saying, it's pretty interesting, is that last time there was a conversation about the Fed raising interest rates, the markets really sold off in a big way. So the markets did not want that. The dollar was rising, the markets fell, and pretty significantly, and everybody felt like the world was going to come to an end if the Fed raised interest rates. Well, lately, the conversation has been, well, we're not going to raise interest rates in November, but we are going to raise interest rates in December because they don't want to raise interest rates around the presidential election. So nobody's expecting this to happen. this month, but everyone is expecting the Fed to raise interest rates in December. So what does that do? Well, that causes the dollar to start moving higher and strengthening. So what has it done to the asset classes that revolve around the dollar, like oil and gold and the stock market for that matter? Well, all of those, although they've had maybe slight pullbacks, they haven't had, run for the exits kind of drops based on the dollar moving higher. So the Fed is in a good place at this point, according to this article, that they can raise interest rates and it won't have a dramatic impact on what goes on with the stock market. They're not supposed to pay attention to the stock market anyway, but we all know they do. Okay, so the road is clear for raising interest rates. Excuse me. But this is going to be the big one. I mean, this week is going to be crazy. Last week, as you all know, on Friday, Director Comey came out and said we found some emails through another probe of Mr. Weiner, and on his computer they found some more emails that had to do with Hillary Clinton. So he reopened the case. Man, this dude, I can't imagine that he sleeps at night at all because of the stress that's put on him from both sides. So this story says Comey's defenders and critics swap roles as FBI Clinton email probe takes 11th hour turn. So the Republicans were fuming with Comey when he decided not to indict Hillary Clinton several weeks ago. And now the Democrats are fuming with him or at him because he decided at this point to go ahead and reopen the file. And from the Republican standpoint, he's got to have something huge if he's going to make that step and step out in front of oncoming traffic, essentially, and have an impact on the presidential race, as appears that it's going to have. It had to be something big. And now the Democrats are saying because Comey is a registered Republican, he is just throwing roadblocks in front of Hillary Clinton the last couple of days before the election. So, who knows where this is coming from. Like I said, I would imagine he's got real issues sleeping at night. He probably realized he messed up in the first place. He's got an open door to bring it back and, from in his perspective, maybe try to do the right thing. I don't know if it is or it isn't. But it's a mess. And that kind of uncertainty in the markets is exactly what the markets do not like. So the markets closed down a bit, right? But they're way off their lows because, like I said, on Friday they just sold straight down. And we'll take a look at the charts here in just a second. They recovered quite a bit. The NASDAQ still took it on the chin, and this is my greatest concern, the NASDAQ right here. And we'll talk through that in just a minute. But first of all, let's take a look at the upcoming economic calendar for the week. Halloween is coming up on Monday. That's kind of scary. That's a joke. And not a lot going on. Chicago PMI coming out on Monday. Tuesday, the Fed meeting begins. PMI manufacturing, Institute for Supply Management, manufacturing index, construction spending. So that's some good information, but it's not going to be a huge market mover. This is the market mover on Wednesday, at least the first one. We have the ADP employment report, which is the warm-up act for the non-farm payrolls. That comes out at 8:15. Then we go on to oil inventories at 10:30 on Wednesday. Then we go to the FOMC meeting announcement at 2 o'clock on Wednesday. Wednesday is going to be crazy. If you're not ready for volatility, get out of the market on Wednesday. If you like volatility, should be a good ride. Thursday, what we have coming up here is jobless claims at 8:30, just like always. And we've got some basic economic information. Okay, fine, but let's get to the big one, the employment situation, which is the jobs report, which is the non-farm payrolls report. All of those are the same thing. We've got a couple of Fed heads speaking on Friday, and Baker Hughes rig count. All of those are potential market movers. So Friday, once again, is going to be a rough day. The beginning of November. Yeah. And then we have the next week. That is going to be the election on the 8th. So, looking forward to an exciting ride. Let's go ahead and jump into some of our charts here. This is the asset comparison screen where we always start out. You can see this is the US dollar in the upper left-hand corner, and what we were talking about before was the dollar is basically moving higher. Overall, up, 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 retracement up, retracement back. Looks like old resistance is now becoming new support for the dollar, and this is the 50 period moving average. This is the 200 period moving average. I know my colors are off. Usually they're red and green, but they're blue and green here. Let me go ahead and change that up. Back to normal. Okay, so this is what's known as a golden cross on the dollar. So that means that we've got extreme bullishness where the 50 period moving average is crossing up through the 200 period moving average. So potential exists that this will continue to move higher based on that golden cross. Now, how does the US dollar affect the rest of the asset classes that we're looking at here? Well, let's skip over the spiders. We'll come back to that. Gold, if the dollar goes up, gold should be going down. Not so much. Looks like it maybe found a floor. We left a long wick on Friday, which usually means that there's a potential of a retracement to come back to the downside. That could be the top of this move higher. But actually, I think that there's a possibility with all of the uncertainty in the markets that we'll make a move up to 125 from 121.58 where we closed on Friday up to 125. That was the old support level that I believe will become the new resistance level. But still, that's about $3.50 worth of movement to the upside. But not necessarily based on what's going on with the dollar. I believe that it's going to be based on what's going on with the election. Okay? We also have U.S. oil. Oil came up to roughly $51.50 and found a resistance level and now is starting to retrace back down. We closed at $48.61 on Friday. So the folks that were saying we're heading up to 60, this is a retracement on that. I'm not sure that I believe that that's going to happen. I think that we'll probably float between 45 and 55 for the foreseeable future. Our D extension is pretty close to 55 bucks. If we get up that high, we came back down. You can see on these fibs, we came back down to a 0.618 retracement and then started to move higher. Ran into resistance at the 1.27, and now we're fading back down. So that is a pretty standard pattern. We always run into these resistance levels between the 1.18 and the 1.27 level and retrace back down a little bit. Could we get up to our D extension at 1.618, approximately $55? I think there's potential for that. As long as the dollar moves higher, though, the expectation, the standard economic move, would be that if the dollar is moving up, oil moves down because it takes fewer dollars to buy a barrel of oil, which is traded in U.S. dollars. So we'll see what happens with that. We also have the VIX that was rising this past week. This is the VXX. It's not the VIX proper. It is an exchange-traded fund that is traded on the VIX. Or based on the VIX. So we had a big day on Friday on the VIX. People got a little concerned, but we're at historic lows, and this is absolutely crazy. But I think that we have the potential to move a little higher just recent or based on the information that came out this week. So a lot of good movement in the markets, in the asset classes. Let's go ahead and jump into the spiders here and look at a couple of things. I think we need to really be students of what's going on with support levels at this point. A couple of things that I'll point out to you, and we'll begin with the weekly chart of the spiders. The weekly chart of the spiders shows that we have been moving to the downside recently. Let me move this up a bit. And we've had a downward transition over the past, this is a weekly chart, 1, 2, 3, 4, 5, 6, 7, 8 weeks we've been moving to the downside. I think we could actually say 9 weeks. But overall, 8 weeks, 2 months worth of movement to the downside on the spiders. Now, we don't seem to get anywhere fast, but if you look back over here on the left-hand side of the chart, you can see there's a lot of gobbledygook over here that we can say this is a resistance level, and that resistance level is now becoming support. Now, I might actually be able to move this up to this level where we see that there was resistance, a closing resistance, 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 so on and so forth. So overall, we have a downtrend line capping the top, and we have a support level that we're paying attention to right around 212-ish. Okay, let's say between 211 and 212 and 213. We'll say that because we can probably go ahead and, if we put in a high at this level, and we move this down to the top of this candle right here, there's quite a few touches of that price level right through here. Let's say that our support area now is between 212.50 and let's call it 213.50. All right. Now, the one thing that I'll point out about, or one of the additional things I'll point out in this weekly chart is that the weekly chart stopped right at 212.54, right on the support level. Now, the question is, are we going to get a bounce to the upside? Well, there is that possibility because that's been the history just lately. When we work the downside support levels, we have a tendency to get a bounce to the upside. But you'll see by looking at this chart that the highs that we move to have been consecutively lower highs on the way down. So there's only so much room where we can actually make this thing continue to pop higher before we break one direction or the other. Now, if I come back and look at this uptrend line that's been put in place since February of this past year, touch point 1, touch point 2, 627, what we've just done is we have broken that uptrend line and closed beneath it. So that's going to be a negative. If you're a bull, that's a negative. If you're a bear, that is a positive. We still have our support right around 212, but we need to be students of that 212 mark on the spiders, because if we break that 212 mark and close below it, our next stop initially is probably going to be 206. That's going to be the 50 period moving average, but now you can see that the 50 and the 200 are right on top of each other. So there's not necessarily another support level if we break 206 until we get down to, let's just call it this low right here, is going to be 198.50. But the real support that we're looking at is all the way down here at our A boundary, which is 181. That is a crazy big drop in the spiders if we were to get there. Now, that's on a weekly basis. This is probably going to happen immediately, and I'm not saying it's even going to. What I'm saying, though, is we've got to watch that 212 level on the weekly chart. Now, let's stack up some of the information that we've been given over this past week on the spiders. Again, this is a daily chart, and this is our downtrend that we put in place right here, and we are crossing through the uptrend, the most recent uptrend. So let me show you that a little bit closer. Right here is our uptrend line, again from February. This is the June touch, and we continue to move to the high side. So what does that do on the daily chart for us? Here's our 212 support, or resistance level. We've got an uptrend line that we have actually closed beneath. Now, check this out. We closed beneath this uptrend line one time, and then we bounced above. Came back down, hit the resistance level, then went through and started to come back down again. Now this is the 50 period moving average. Excuse me, this is the 120 period moving average, the purple line. And this is the significant one to me at this point on the daily chart of the spiders, because that's 120 period moving average has been acting as a support level with the exception of this guy right here. Okay, so we tried to close beneath it, we couldn't. Support, tried to close beneath it, we couldn't. We did close beneath it, we popped above it, support, 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 close beneath. That's the first concern. The second concern on the spiders, again, is watching that 212.50 level and looking for the next support level on the daily chart. We come down here to the 200 period moving average, and that's at 207. All right, 207 is basically going to be the 0.50 retracement level on the spiders. So is that a legitimate support level? Yep. We'll also have to drop through this low of 211 to get down to this support at 206 or 207. But with the amount of volatility that's in the markets right now and uncertainty, I think that that is a possibility. So again, we've got to watch. Our downtrend here has overpowered our uptrend. We are now trading beneath the uptrend line, and we are trading beneath the downtrend line. So that is a bearish signal. We're using the 120 period moving average as resistance on the spiders, and support is at 212. So we've got to watch those levels. All right, watch those levels. As a matter of fact, this information right here, this was what I wrote on the chart for last week's class, because last week we were sitting right here. So this was our uptrend resistance. Our support was at 120, or the 120 period moving average. Now this is what I did not anticipate. We jumped up, hit the downtrend resistance line, and then moved back down, and now we are using the 120 period moving average not as support, but as resistance. All right, now let's take a look at the Qs. This one gets a little ugly. So here's the weekly chart. I know I've got a lot of trend lines drawn on this, but this trend line right here, moving up, this is a trend line that is showing you the higher highs that have been achieved. Yay, higher highs on the Qs. So that's a bullish sentiment, right? Moving up, higher highs. We also have higher lows moving up. That also is bullish. But notice what has happened here. This is the $100 mark on the Qs. That happens to be at the 50% retracement on our current set of fibs. This is the 0.618 retracement. You can see that we came down to a 0.618 retracement, got to move higher, broke above the B boundary, and all of that is bullish. Everything here appears to be bullish, except the most recent trend line that we've got drawn here, this one right here, touch point, that's the center point of this candle. You can see what we've done here. We dropped beneath it, we ran up, challenged the south side of that trend line with the white candle, the bullish candle, gapped up, sold off. And you can see our touches on this uptrend line have held intact. So this uptrend line is acting as resistance now. But these two candles right here, side by side, this is an indicator that things are not looking so good for the markets. All right, these two bearish candles very close to one another. The way that we typically teach a tweezer top formation is that 60% of the total height of the candle would have to be wick to the upside of the candle, but not all technical analysts believe that is the case. Tweezer top oftentimes can be similar highs right next to one another. Now, these two candles, these two bearish candles, show that the market tried to push to new highs and came back down. The market tried to push to new highs and came back down. We've also been challenging the south side of this most recent uptrend line. So there is a good possibility in my estimation that based on our stochastic oscillator down here, which now has both lines broken beneath the 80 point, and blue, your stochastic line, is falling through your percent K line, that's a bearish indicator that we've got a problem. Also notice this. As we look at what's going on with the stochastic oscillator, you can see that it has been moving down. This is a divergent move from price moving up. So this is a signal that we've got something going on here that could lead us into either a significant move higher, which would take the stochastics higher, or a dramatic move to the downside on the Qs based on the overbought conditions. And I believe that this is leading us to a signal where the markets are going to start to move to the downside. So that's the weekly look at the Qs. Here's the daily look at the Qs. Let me tighten this up a little bit so you can see it better. All right, I have a lot of trend lines to deal with here. First place I'll send your attention is down here to the stochastic oscillator, where we are clearly below the 80 level now, heading down towards the 20. That is a bearish signal. And as we look at all of these pixie sticks, no, not pixie sticks. Oh, that was candy back in the day. Pickup sticks. You remember playing that game, pickup sticks, where you took a bunch of long, narrow sticks and you just dropped them, and you had to pick a stick up without disturbing the others? That's kind of what this looks like right here. So we have this long-term trend down here. That one is not in jeopardy at this point. Then we start moving up a little. We move up in time a bit. And if you started a trend line here, again back in February, where a lot of our conversation has begun, this is February 8th, we moved up, retraced back, we fell through the trend line that we had right here, right? And I know we're not supposed to do that, but oftentimes these trend lines that have been breached come back as players later on down the road, and that's exactly what's going on right now. Oh, let me get that back. That's what I want. All right, so support, support, fall through, up, support, support. And if we zoom in here a little bit, you'll be able to see that recently, support, 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 break. That was Friday. All right, so that old trend line is significant in our looking at the market. Okay, so let's move forward in time a little bit. We've got one long-term trend line. We've got an outer trend line. Then we've got an inner trend line that we should apply right here. Now, I know we broke this trend line already. So what's the next one that's intact? Here we go. So this trend line begins with this low that was established on, looks like it was June 2016. We ran up, yep, June 27th. Ran up, retraced back. That's the previous trend line that we were just talking about. Moved up, came down. This is our second touch right here. So it was really pretty recently That is October 13th. Then we moved higher, set a higher high. That's why this shows us moving to the upside in a bullish fashion. Came back down. Now we have gone through that uptrend line. Now, the interesting part about this to me is that these two lines, although they start in different places, these two trend lines, they cross right here where the 50-period moving average is sitting. All right, so these two trend lines crossing, as well as, oh, let me get that back. The 50-period moving average, this is a major point of confluence. Now, these comments, again, resistance at 118, 50-period moving average is key, and support at 116. These were comments I had last week during the SPY the Market. But let's see what's transpired since then. Last week, that was the candle we were looking at during the SPY the Market. That was Friday's close. So what happened? We had a resistance level that was put in at 118. We gapped higher, moved dramatically higher on Monday. On Tuesday, dark cloud cover. That is a bearish candlestick formation. Gap down, gap up, close down, right on our trend lines. That was our support level. And then on Friday, we came down, gapped significantly lower, ran up, used the south side of the trend lines as resistance, and then closed down below the 50-period moving average. This right here is the most bearish signal that I have looking at these charts. Obviously, I've been a little bit concerned about where we're going on these charts as far as whether or not we have the ability to move higher. But that right there is the biggest concern that I have. So this is the place that we would be looking at. Keep in mind that 118 level as resistance again. But the bigger issue right now is the close below the 50-period moving average, which happens to be at 117.5. So on Monday, if we can't rally the troops and close below that level, we would be again looking at 116 as our support. And if we break below 116, the next support level is going to be, we're just going to have to keep our eyes on these moving averages. This is the 120. It's at 113.5. Here's the 200 period moving average at 110.15. So watch 116 on the Qs. If you're going to write down significant support levels, write down the 50-period moving average as resistance and 116 as support. Then we move on to the diamonds. The spiders and the Qs have the most ominous looking charts at this point, because the diamonds have been moving down for some time. Since mid-August, they have been moving to the downside. This is the daily chart. We've been trending sideways, but we've also been moving down because we broke through our uptrend line that was being used as support, break, and we're never able to get back up above that trend line. Now we've got a downtrend line in place, and that is acting as our resistance to the downside. All right, so you can see that the 120 period moving average appears to be a major player in the markets. There are a lot of traders using that as a support level and a resistance level, but the next move to the downside is under the support level of 180. If we break below 180 on the diamonds, next stop is going to be the 200 period moving average at 177. And after that, we don't have another stop until we get down to the A boundary. So the support level we need to be watching is number one, the 120 period moving average at 181.33. Secondly, the support level at 180, which is probably the bigger one at this point. And if we break down through that and close below it, we should expect to see another move to the downside that would show us support at 177 on the spiders. Then we go to IWM. IWM is the ETF that tracks the Russell 2000. These are small cap stocks. And let's see how this loads in. The IWM is hurting in a big way. So let's look at this from a couple of different perspectives. We had a support level right in through here that the IWM was holding on to until Wednesday. Wednesday we closed through. Thursday we dropped dramatically through into our next support level, which happened to be our B boundary, or you could say that it was perhaps this level here that corresponds 119, which corresponds basically with the 120 period moving average. And now puts would be the order of the day as we move down towards the 200 period moving average at 113.87, call it 114. So we've got about 4 points to go to the downside. So I think we've got some major put opportunities here on the IWM. You can see we put in a higher high, a higher low, a higher high, a higher low in relationship to this one. Then we put in a lower high and a lower low, and that is the turning point for the IWM. Now, we look at a lot of data on these charts, and we draw them up from the perspective of saying, well, you know, if this happens or if that happens. Well, real quick, let's take a look at what the Ultimate Market Scanner is telling us about the four major indice ETFs, the Qs, the Diamonds, the Spiders, and the IWM. They are all very bearish, and the Qs now has a pre-sell at 116.73. Now, if we go in and we look at the Qs, show all time frames, except for the weekly, all time frames are bearish. All time frames are bearish. So let's take a look at the Qs, where we see our pre-sell at 116.73, and the targets are at 112, and let's call it 110. Okay, close to 110, 112, 110 on the Qs. So let's go ahead and put those in. I'm going to go ahead and label these. This is 112. Oh, that's 112 already. And this is 110. UMS target number 1. And then we'll put UMS target number 2. And that's going to be 110. Okay, so based on what we have going here, here's what we can see. Target number 2 at 110 is our 0.382 retracement. All right, target number 1 is coming in line more with these areas of support and resistance right in through here. But target number 2 matches up nicely with a 0.382 retracement. That is a point of convergence. Now we go back to just want to show you what this chart looks like here on the Qs. Pretty significant drop from 116 to basically 110, a little below 110. All right, so let's look at the, let's go to the spiders next. Show all time frames. Everything is short with the exception of the weekly. But that one is closed. All right. So what do our targets look like? Our targets take us to 208 and 194.50. 208, 194.50. So let me throw in a couple of horizontal lines. So 208. That's basically the 0.50 retracement. And 194.50 will have changed, broken through the A and taken us basically to this level right here. So UMS target number 1. UMS target number 2. 194.50. So a break of 212 and it's going to get ugly. A close below 212, let me say that, and it's going to get ugly. First stop, 4 points. Second stop, yikes, 14 points below that. All right, let's go to the diamonds. Show all time frames. Everything is bearish except for the weekly. And if we go to the chart, this one's not quite as impressive as far as the stops go to the downside, or the targets to the downside. We're still at a place where we're trading, go short at 180. That's about 5 points to the downside on the diamonds. And our target is 177 and 175.75. So target number 1 is just below the 0.50. Target number 2 is just below the 0.618. And again, based on a break and a close of 180, 3 points on the diamonds, and then another 2 points to the downside. And target number 2. All right, so we've got the diamonds, and now we have the IWM. And the IWM says our targets, well, show all time frames once again. Everything is bearish, even the long term has a pre-sell at 117. This target is, first of all, 3 points down for the 50% target, and it is 7 points down for the secondary one. But let's play around with these guys right here. So 119.57 and 117.18. Let me go back and double check that again. 119.57 is pretty darn close to where we're at currently. Oh, we already hit that one. My bad. Wasn't paying attention. So the second target is 117.18. So we already took out target number 1. Target number 2. All right, there we go. So we've got some good targets based on what our UMS is telling us. We've got some great technical analysis telling us that we agree with what's going on with those targets, especially on spiders and the Qs. And I think based on all of the information, all of the economic data, and the uncertainty about the election, this is going to be a crazy volatile week. And when I say crazy volatile week, expect some big swings in the market, and look for our support levels: 212 on the spiders, 112 on the Qs, oh, I lied, 116 on the Qs is going to be the big support level. And then the diamonds and the IWM should expect to move to the downside as well. Y'all saw what went on with the Amazon position that we had on the other day. Based on the earnings report, earnings came out, basically moved down. By the close of the day, it was down about 4%. We need about 8 to 9%. I think it was 9% to make our complete move. I still think that that is a good solid potential. I think this is a good trade that we've got on earlier. Right after the earnings announcement was made on Thursday of last week, Amazon did drop 9%. It moved the entire move, but then it retraced back up. So I think maybe on Monday, depending on what happens with the market in general, Amazon may be having a move to the upside because people think that it's a buying opportunity. But overall, I still think that Amazon still has a ways to go to the downside here for a legitimate retracement before people are willing to step back in to this trade. Now I don't have this set of charts that I have doesn't have the current Amazon straddle drawn up, but we do have the initial move taking place. We just need it to continue to drop, and it is on its way. So there we go. I hope you enjoy the rest of your Sunday. Don't forget Kevin tonight with the Sunday evening planning session at 5 p.m. Eastern, and Angie and Kevin will be back with you on Monday to jump into the markets during opening bell and the weekly or the daily option session on AOD. I'll be with you on Tuesday night along with Angie to walk through our Tuesday planning session, and then I will be on the mic on Wednesday as well for the best practices for the charts. All right, so enjoy the rest of your day, and we will talk to you soon.